Okay, good afternoon, everyone. Welcome to another virtual event of the Basquiat Society of Washington, D.C. My name is Steve Dewey, and I'm the chapter director of our Washington, D.C. chapter. The Basquiat Society is the public outreach program of the American Institute for Economic Research, otherwise known as AIER. We promote the principles of free market economics, sound money, property rights, limited government, and a free society. If you'd like to learn more about AIER and the Basquiat Society, our website address is aier.org. For our event today, I'm very honored and excited to have Professor Larry White as our featured speaker. He will be speaking on the history of monetary systems from gold-based currencies to government-controlled fiat currencies, and the recent development of market-driven cryptocurrencies such as Bitcoin. He will also examine the reasons for the creation of the Federal Reserve System in 1913, its record of performance since then, and whether market alternatives for money and banking should now be considered over the Federal Reserve System and other central banking authorities. A brief summary of Professor White's background: he is professor of economics at George Mason University, a distinguished senior fellow with the F.A. Hayek Program for Advanced Study in Philosophy, Politics, and Economics at the Mercatus Center, and he's also a senior fellow at the Cato Institute's Center for Monetary and Financial Alternatives. Professor White is a leading expert on money and banking history and monetary theory. He is the author of several books, most notably The Clash of Economic Ideas, published in 2012, and The Theory of Monetary Institutions, published in 1999. He is also the author of several works, including The History of Gold and Silver, published in 3 volumes in the year 2000. Professor White received the 2008 Distinguished Scholar Award of the Association of Private Enterprise Education. He has been a visiting research fellow with our sponsor, the American Institute for Economic Research, a visiting lecturer at the Swiss National Bank, and a visiting scholar at the Federal Reserve Bank of Atlanta. He is co-editor of the online journal Econ Journal Watch, and he hosts its bi-monthly podcast, EJW Audio. His articles on monetary theory and banking history have appeared in the American Economic Review, the Journal of Economic Literature, the Journal of Money, Credit, and Banking, and other leading professional journals. Professor White earned his AB degree in economics from Harvard University and his MA and PhD degrees in economics from UCLA. Before we get started with our discussion, please note that our event is scheduled for 75 minutes until 2:15 p.m. And we will reserve some time at the end of the event, probably at least 20-25 minutes, for a Q&A session with attendees. If you have any questions that you would like to ask, please submit them using the Q&A button at the bottom of the Zoom screen. So now I will turn it over to our featured speaker, Professor Larry White. Professor White, please proceed.
Thanks, Steve. Let me share my screens because I have a few pictures to show. There we go. Oops. And okay. So the title I was given was Market Alternatives to the Federal Reserve System. But as Steve said, I'm going to talk a lot about the history of how we got to a Federal Reserve System and how markets handled money and banking before there was a Federal Reserve System, or more generally, before there were central banks in the world. And then I'll talk about what the alternatives are today. What are the realistic options if we want a depoliticized monetary system without a central bank? the first point I want to make is that money is an ordinary economic good. It's sometimes assumed that there's something special about money that requires it to be provided by a government. But like a chocolate donut, money in your pocket is a private good. That is, only you can use it. It's rival in use, in consumption. And it's easy to stop other people from using your money balances. So it's excludable. Those are the technical terms used to distinguish private goods from public goods. So money's not a public good in the technical sense. It is a good, however, which is very commonly provided by governments, although not exclusively. Even today, most of our money is privately issued in the form of checking account balances. But the supply of those is controlled by central banks who create the underlying or basic money in the system, which banks hold as bank reserves and which you and I hold as Federal Reserve notes. So there's a bit of a puzzle here. If money's an ordinary private good, if markets did not fail to produce money, how did it come to be that governments took it over? Was this for good reasons or bad reasons? And I'm going to suggest mostly bad reasons. And at the end, I want to come to the question of, would we be better off by ending government control in favor of a market alternative? And the two, I think, are the leading candidates are a gold standard or a Bitcoin standard. Gold is not the only possible monetary commodity, but it's got a history, and we still have huge gold reserves that aren't doing anything today that could be put back to use as monetary reserves. Bitcoin's not the only cryptocurrency, but it's certainly the most prominent and the one with the most developed payment system and supporting institutions like exchanges and wallet producers and so on. So I want to talk about how money historically has behaved and how it can behave under guidance by competitive market forces rather than by central banks. And just to be a little bit reductionist here, to simplify things, there are basically two views of money. There's the state view of money and the market view of money. And the state view I have symbolized here by a wise king. That's a light bulb over his head. And part of the state theory of money is the idea that some wise king invented and introduced money into human society. Whereas the market view, symbolized here by a sculpture that's supposed to illustrate the invisible hand of Adam Smith. And of course, it's a little bit of a paradox. If the symbol, if the logo were literally invisible, you couldn't see it. So you can see it, so it's not quite invisible. But the invisible hand is the idea that money emerges, or social institutions more generally, emerge from the bottom up. And we can understand their coming into existence without having to posit some wise king who created them. The state theory of money has been quite recently represented by Representative Jim Hines of Connecticut, who made the statement, which kind of pierces my heart because it indicates that my entire career has been a waste if he believes this. He's apparently not aware of any the research that I or other people in this line of thought have done. He says there's not a single shred of evidence over many centuries that new financial systems or new systems of currency grew organically and in an unregulated way and lead to good outcomes. Whereas my whole life's research program is providing that evidence. There's plenty of shreds of evidence. So the most satisfactory, or the first satisfactory theory of how money came to be provided by markets we owe to the economist Carl Menger. And Menger said, look, so the picture is somebody bartering a fish for some corn. Menger said, look, it's disadvantageous to try to exchange that way. So when people start trading, they're going to meet frustration in trying to trade directly whatever it is they've brought to market, what they've produced, for what they want to take home and consume. And if you come to market with something very few people want, let's say you're selling asparagus, you're going to have a hard time, and you want to go home with a plaid shirt, let's say, you're going to have a hard time finding somebody who both is selling plaid shirts and wants to be paid in asparagus. So that's the problem with direct exchange. It's hard to find a well-matched trading partner. Might not be impossible, just might take days and days and days. In that case, it's in your advantage to trade your asparagus for something that you stand a better chance of having accepted by the plaid shirt seller. So from a barter economy, people hit upon using various commodities as what we call media of exchange. That is something they acquire in order to trade away later on. So indirect exchange is developed, but we still haven't gotten to money, because the defining characteristic of money is that it's a commonly accepted medium of exchange. So we have to explain why the market converged on a single commonly accepted medium of exchange. And Menger says, put yourself in the position of somebody using indirect exchange. You're going to notice that some goods are more widely accepted when you offer them. And it pays you to then keep track of what other sellers accept in payment, sellers of the goods you want to go home and consume. So if you see, for example, a lot of people accept payment in salt, then you'll accept payment in salt for your asparagus, because now you know there's a big group that you can go and buy things from using salt. But you're accepting salt now adds one person to the set of merchants who are accepting payment in salt, and so it's growing. And by that kind of mechanism, because you made it bigger, you make it more attractive for other people to use salt. So the popularity of something as a medium of indirect exchange is self-reinforcing, you might say. The more people use a particular good, the more advantageous it is for other people to join that group. And so we get convergence on a commonly accepted medium of exchange without there having been any big collective meeting or vote being taken or wise king who says, this is the commodity we should use. It emerges from the bottom up. Historically, we know it was silver and gold. Silver in ancient times and Middle Ages, and gold in relatively modern times, that became the preeminent commodity money. And I see that resulting from what you might call a survival of the fittest, or a social winnowing process. Among various popular commodities, some are simply more convenient to use as a hand-to-hand medium because they're more durable, more portable. That is, they have a higher ratio of value to bulk. They're more precious, you might say. They're more easily divisible, so making change is part of the exchange process. And you would like your medium of exchange to be something you don't have to hassle over, whether it's high quality or low quality stuff. So uniformity is a plus. Gold and silver were actually held back because they're not very uniform as they come out of the mines. It wasn't until metallurgy developed and the ability to purify metals and to create coins as certified pieces of purified metal that gold and silver particularly, drove out other commodity monies, and the whole world that was trading with one another were trading on a silver standard, later a gold standard. So a better money drove out the inferior monies. Inferior, not from my point of view, but as judged by the traders. So the lesson that Menger gives us is money was not invented, not by a wise king, not by Alexander Graham Bell in a laboratory or someone like him, you can see that a telephone was invented. It's a new arrangement of materials. But if we look at these shells served as money in some early economies, but they're not technologically any different from the same shells only serving as jewelry or ornaments. What's different is the social practice of accepting them in payment in the expectation that others will accept them in payment. Right? So they became a commonly accepted medium of exchange that made them money, not any new combination of wires and pieces of metal. Now, the state theory, which is in contrast to Menger's idea, still has advocates today. It goes back to a book entitled The State Theory of Money, published around the turn of the century. But it has advocates today. One of them is Randall Wray, and he makes this rather bold declaration. The monetary system itself was invented, so I've already tried to debunk that idea, to mobilize resources to serve what government perceived to be the public purpose. So this is in big contrast to Menger. But think about what that would require for the monetary system to be invented. It would take some wise ruler who had lived in a barter economy his whole life, imagining monetary exchange and imposing it in one step. And that's just not very plausible. How would he know what it would be like? How would he think of this idea? How would he get everybody else to go along with it? It requires heroic assumptions about the sophistication of one individual, whereas Menger's theory money comes about through a series of small steps with nobody aiming at the final result. When it comes to the development of coinage, the state theorists say, well, proper money or money at all requires a sovereign issuer. A well-known economist named Charles Goodhart says currency becomes money primarily because the coins are struck with the insignia of sovereignty. But there's plenty of evidence against that view. We've got examples of private coinage. And if it were just a matter of striking the insignia of sovereignty on a piece of metal to make it valuable, why use expensive metal? Why use silver or gold? If it's just the state insignia that makes it valuable, why not make coins out of iron or copper and just put values on them well above the value of the copper or the iron, right? That an insignia should be able to do that. But in practice, historically, coins circulated at values reflecting their precious metal content. And so valuable metal was used in order to give the coin value. The value did not come just from an insignia. What the insignias on coins do is to certify, or what they're supposed to do is to certify the weight and fineness of the metal in the coin. And so you can have money without a sovereign insignia. We have early monies, to go back to the shells, that didn't have any insignias on them at all. There was early pieces of silver called hack silver, bearing no insignias. There have been privately minted coins through history, and they have insignias. They have like brand marks, but they're not sovereign insignias. They're mint master signs. They're like brand names to say, here's who is certifying the metallic content of this piece. So the picture below is a piece of silver stamped with symbols from ancient India. The symbols indicate who produced it and certify its value, certify its silver content. There were private moneyers in ancient Lydia, which is where King Midas lived. It's a kingdom in what's now Turkey. there were private minters in what's called Merovingian Gaul, which is the area of France and part of Germany in the Middle Ages. When the Roman Empire fell, they no longer could maintain a mint monopoly, and competition broke out among private mint masters because people still wanted silver coins. And I've recently published a paper in the Economic History Review discussing the experience of private coinage in the United States. There were 3 gold rushes in the US in the 19th century, one in the Southern Appalachians, the most famous one, of course, in California, and then a little later in Colorado. And in each of these cases, private mints arose to provide for miners the service of turning their raw gold, which was hard to barter with because nobody was sure how pure it was. So it was a hassle. Mints provided the service of certifying the fineness and the weight of pieces of gold. So there was a mint in North Carolina run by the Bechtler family, and on their coins, they stamped how many grains of gold, that's a weight measure, and how many carats, right? That's a well-known measure of purity, where 24 karat gold is pure gold. Their coins were mostly 21 or 20 carats of gold, depending on the gold they got from the miners. But they put more gold in the low carat coins in order to, more metal, I should say, they weighed more in order to contain the same amount of pure gold. We also have the experience of the 19th century, well, actually beginning in the 18th century, where the most popular kind of money people used was privately issued banknotes, right? Currency redeemable for gold or silver, but issued by commercial banks. And so they have no sovereign insignias on them. The lessons from the American episode in Private Coinage were that not all the mint masters immediately were honest or competent. There were some who tried to get into the business who either didn't know quite how to assay gold, or were looking to make a bigger profit by overstating the value of the gold in their coins. They quickly got weeded out. How? Because newspapers would publish assay results of people having tested those coins. And when the word got out that your coins were underweight, that was the end of your business. Nobody would want to take underweight coins. So people who had them already had to take them to a different mint with a good reputation and have them melted down and recoined. The private mints that produced high quality coins stayed in business. The ones that produced bad coins went out of business in a matter of months, and they didn't issue very much before they were found out. Whereas the ones that stayed in business issued a lot, millions of dollars worth. So the market handled the problem of maintaining the quality of the coinage by the simple mechanism of people testing the coins and reporting the results to the newspapers. Historically, of course, governments elsewhere had long monopolized the production of coins. In the US, the production of gold and silver coins was perfectly legal until a law was passed during the Civil War to make it illegal, presumably because the government didn't want private mints competing with their new greenback currency. When governments monopolized the mints, it wasn't to produce higher quality coins. They notoriously debased the coins. And why did they do that? Because there was a profit in it. There were 2 sources of profit, actually. They could make a profit without debasing just by charging high fees for the service of taking your raw silver and turning it into coins. And they could enhance that profit by making themselves the only mint in town, or the only mint in the country. And it was typical that they banned the use of foreign coins, at least foreign silver coins, to enhance. It's pretty obvious that they're trying to enhance their own profit. But the notorious source of profit was issuing underweight coins, debased coins. Debasement means reducing the silver content. And then how do you get them to circulate at a value higher than their intrinsic silver content? Well, you pass a law that says people have to treat them as the equivalent of older full weight coins. And those are called legal tender laws. You declare the new lightweight coin legal tender for all debts denominated in the old coin. And then, of course, Gresham's law takes hold. People won't spend the heavy coins when they can spend light coins for the same purchase or for repaying the same debt. And so the heavy coins disappear from circulation. And so the profit from debasement is actually temporary, because soon the debased coins are only going to be taken at a reduced value corresponding to their reduced silver content. On the other side, government mints were clearly after a profit when they said that they were the only allowable buyers of gold and silver. So in Spain, if you were bringing gold and silver back from the New World, you couldn't shop around and see which mint was offering you the best deal. You had to go to the Royal Spanish Mint, and they paid you a lower price for gold or silver than the competitive price. The picture at the bottom of the screen shows the debasement of the Roman coinage. You can see it physically getting darker and more deteriorated as it contained less and less silver. Well, the market responded to this problem that you couldn't trust coins anymore to have the declared silver content because the government mints were debasing them. Private coin changers began keeping people's deposits, and they began keeping them not in coin names, not in ducats, but in ounces of silver. So the coin changers were experts on how much silver was actually in a ducat this year. And you can see from the picture that part of their business was weighing coins. So in the picture, the Italian banker is putting a bag of coins on a scale to weigh them, because the coins were variously worn and sometimes shaved. And then he's writing in his book the credit into the account of the person who brought him the bag of coins. And the units he uses to record the credit are pure silver units. So this is a great convenience to traders. It was easier to trade with bank deposit balances, that is, write each other checks or the medieval equivalent, than it was to deal with coins. Not only were the coins bulkier, but they were, and nobody knew what value they were if you used physical coins. So when merchants went to big trade fairs where they would buy and sell, they would pay in claims on their bank, and their banker would come to the fair too, and he would settle up offsetting claims. And only at the end of the day would net claims have to be settled in a little bit of gold or silver, but merchants didn't have to drag bags of coins to the fair or home from the fair. They transacted in bank issued deposits. Later, banks got into the business of issuing paper currency, which is a way of paying people without needing your banker present or without needing a bank account. So workers in the 19th century were often paid in pay envelopes stuffed with banknotes. Banknotes are IOUs issued by commercial banks, and you can read the debt contract right on the face of the banknote. Right, the one at the top is in a very early banknote. It's actually handwritten. The one at the bottom, a little more modern, it's printed with anti-counterfeiting devices. But you can see it says at the top, redeemable in gold coin at the office of this bank, which was the National Gold Bank of Stockton, California. During the Civil War, California never went on the greenback standard. They stayed on the gold standard. And so to get banks, to get banknotes accepted in California, banks had to make them redeemable for gold coin, not for greenbacks. Now, a common worry about having many different banks issuing their own currencies is that how can I deal with 20 different fluctuating currencies? And the answer is they don't fluctuate against each other. It's advantageous for a bank to make its liabilities circulate at par in terms of silver if you're on a silver standard, or gold if you're on a gold standard. That's what determines the face value, the amount of gold you get for it. And then the question is, does it circulate at 100 cents on the dollar or at something less? And it's in the interest of the bankers that their claims, the banknotes and checks, should be accepted at 100 cents on the dollar. Anything else would be very inconvenient for their customers, and their customers would go to the banks that succeed in getting their notes and deposits accepted at face value. And so that's what happened. Banks realized it was in their self-interest, because they would get their own claims more widely accepted, to make agreements with other banks. If you accept my notes at par, I'll accept your notes at par. In Scotland, there was a note exchange system where if you started a new bank, the first thing you did was sign up other banks to let you be part of this system. In the United States, there was a famous note exchange system run by the Suffolk Bank in Boston, where other banks would have accounts at the Suffolk Bank to clear against, but the Suffolk would accept their notes at face value in Boston, and that allowed their notes of many banks to circulate at par value. And the system eventually extended to all of New England. And so there wasn't the inconvenience of fluctuating exchange rates between different banks' notes any more than there is today between different banks' checks, right? A $10 check written on Citibank buys the same as a $10 check written on JP Morgan Chase. Same thing with banknotes historically. So a freely evolved monetary system had a definitive money defined by gold or silver coin, or specie is the technical term for coined precious metal. The pricing unit was defined, the unit of account was defined in terms of gold or silver. So in the United States, it was a dollar, but the dollar had a definition in terms of silver and then later in terms of gold. So it stood for a certain weight of silver or gold. And then the money people used every day wasn't coins, it was bank issued currency and checking balances, transferable account balances. You had many issuers in the systems that allowed banks to do this. They're all denominated in a common unit. They're widely accepted at par. The banks get together and clear the claims on each other that they've accepted during the day. So a bank that issues more notes is going to find more notes coming back to it at the clearinghouse. But there's no central bank. There's no government institution that's running the system or supervising the system. It's a private club of bankers, the Clearinghouse Association, that you could say is running the system, but really it's doing only what its members want it to do. So it doesn't have any authority that wasn't voluntarily given to it by banks. And that's what you see in banking systems that allowed it to happen, that didn't quash it through legal restrictions. And there were a lot of them, were more than 60 cases of competitive note issue systems. Most famously, the Scottish system, which was the subject of my first book that Steve didn't mention, called Free Banking in Britain. If you Google it, there's a free PDF version available for download. In the Canadian system, so it's a very nice contrast between the Canadian banking system and the US system. The problems the US had because it restricted its banks, Canada didn't have because it didn't restrict them in those ways. And I'll talk more about that when we talk about why there was a Federal Reserve Act. Sweden had a very stable system of competitive note issue. And New England had pretty, although you had to get a bank charter to start a bank, the state governments gave out bank charters pretty competitively. They didn't restrict the supply of bank charters in order to create monopoly powers, unlike legislatures in some other states. Now, I should say there were laws passed by some state legislatures in the 19th century called free banking laws, but they weren't free banking in the general sense of minimally regulated banking. The so-called free banking laws did make entry into banking more routine, but there were minimum capital requirements, and most importantly, the banks had to agree to buy state government debt to serve as collateral, as a redemption fund for their banknotes. And that was an important restriction. And maybe most importantly, there was no branching across state lines in the United States. And in some states, it was one bank, one office. So that was an important restriction on banks. As far as the regulation of the quantity of money being issued, right, people worry that if a bank is allowed to issue as much money as it wants to, won't it just go wild issuing unlimited amounts of money? And the answer is no, because the money is redeemable. The bank has a contractual obligation to buy it back for gold or silver. And so they can't afford to issue unlimited numbers of claims. They can only issue as many as they can safely redeem. So a bank has a certain amount of reserves, and it knows how often its circulating liabilities and its checking accounts are cashed out. Then they need to hold a reserve sufficient to redeem the liabilities in circulation. And they can't put just additional liabilities in circulation at no cost, because they'll just come back for redemption. Right? So that is what's going to restrict the amount they can issue. They can only issue as many as their customers want to hold on to. If they issue more than that, the notes will come back for redemption and the bank will lose reserves, which means the whole operation was unprofitable. If you have many money issuers in this kind of system, they might randomly, one bank might randomly issue a little more than the public wants to hold, or a little less. So you may get some random money supply errors, but in the large, they'll cancel out. And more importantly, there's a mechanism, the mechanism of adverse clearings that I've alluded to, that will discipline a bank that overissues. It'll find itself losing reserves, and that's the signal: don't issue so many liabilities. And if a bank issues fewer liabilities than the public wants to hold, it'll find itself gaining reserves. And that's the signal that, you know, it would be profitable to issue more. So the clearing system is adjusting day by day, week by week, the quantity of money to the quantity that the public demands to hold. And that's true at the level of any single bank, but it's also true at the level of a regional economy, because if hypothetically, if all the banks overissue together, then there'll be a loss of reserves to the rest of the world as people spend some of their extra money, their excess money, on buying goods from outside the region and paying by transferring the interregional money, which is gold or silver. So there's a big debate over whether to make the Bank of England a central bank, a monopolist in note issue. And there's a school of thought, which I call the free banking school, who said, no, you'll get fewer money supply errors if you decentralize and let the clearing mechanism work. If you have just one issuer, then you have a danger of that issuer making a mistake. It's going to be a doozy. It's going to affect the entire system. And the correction is going to be slower because it's going to be through loss of reserves to the rest of the world rather than to the bank next door. But the Bank of England won the debate and served as the model for later, for other countries later to create central banks. So government central banks took over the issuing of currency, through legislation, not through market forces. This was not a spontaneous development. The Bank of England got a charter way back in 1694, but an important step was the government promising not to charter any other banks of issue in exchange for the Bank of England agreeing to lend the government money. So there's a fiscal reason why governments sponsor central banks. They want to have somebody on hand who's obligated to lend the money when they ask to borrow it. When the government central bank becomes the only issuer of currency, then other banks no longer issue currency. They no longer have a reason to hold gold reserves. When their public wants cash for their checking deposits, they'll accept central bank notes. And so you find all the gold collecting in the central bank and other commercial banks holding very little gold. And once the central bank has all the gold, it controls, or it can intervene to control the inflow and outflow of gold from the system as a whole. So the Bank of England could raise interest rates to try to attract gold from the continent in order to stop gold from flowing out quickly when there's an excess. So they're not helping the gold standard by having an interest rate policy. They're actually obstructing the automatic operation of the gold standard. Now, it isn't often seen this way. So here's a mainstream opinion from the blogger Matt Iglesias. Once upon a time, governments didn't issue paper currency, and instead banknotes were printed privately by banks. Completely true. But the second sentence, but over time, we came to see this as a worthwhile public service. That is not how central banks were created. It wasn't some public consensus that it would be a good thing to have a public option in banknotes, much less a public monopoly in the issue of banknotes. Here's a more interesting discussion in mainstream media. This was a few years ago, but Alan Greenspan went on Jon Stewart's show, The Daily Show, to plug his book, which you see Stewart holding in the picture. The book came out right after the financial crisis, and I think the title was Don't Blame Me, something like that. But somebody wrote a very good question for Stewart to ask of Greenspan, namely, Greenspan had written in favor of the gold standard in the 1960s, and Stewart is kind of picking up on that. He says, many people are free market capitalists, meaning you, Alan Greenspan. They talk about free market capitalism, and that's our economic theory. So why do we have a Fed? Wouldn't the free market take care of interest rates and all that if we let it? So putting Greenspan on the spot, and Greenspan first kind of hums and haws, but then he gives a rather frank answer. He said, consistent with what he had written earlier in his career, you didn't need a central bank when we were on the gold standard, which was back in the 19th century. Well, he's finessing the dates a little bit here. And all the automatic things occurred because people would buy and sell gold, and the market would do what the Fed does now, by which I take it to mean you'd have an adverse clearing mechanism, you'd have an international price specie flow mechanism that would regulate the quantity of money. Now he says 19th century, but the Federal Reserve Act was passed in 1913 when the US was still in the 20th century, the US was still on a gold standard. So following Greenspan's argument, the US got a central bank that it didn't need. At least it didn't need it for monetary policy because the gold standard was regulating the quantity of money. And in fact, it's not to regulate the quantity of money that the Fed was created. But before I get to that, Stewart follows up by saying, so we're not a free market then? And Greenspan says, that's right. To the extent there is a central bank governing the amount of money in the system, that is not a free market. So why was the Fed created if not to regulate the quantity of money? It was because there were banking panics under the preceding system of bank regulation, which was called the national banking regime, was created during the Civil War in order to help finance the Union War effort. And this system was a little bit fragile. There were a series of banking panics 5 of them, the biggest of which was the Panic of 1907. Why was the banking system fragile? Because the national banking regime didn't do anything to reduce branch banking limits. Although they were called national banks, they couldn't branch across state lines. We didn't get interstate banking until the 1990s. That's how powerful the lobby against it is. And the national banks had to hold federal government debt as collateral for their banknotes. That was a concept the federal government took from the state governments. But that made the quantity of currency very inelastic. That is, it didn't go up in seasons when people wanted more currency and go down in seasons when people wanted less currency. When people wanted more currency, say farmers wanted to pay their farmhands in the fall, they would go to the bank and the bank would say, I can't issue any more banknotes. And the farm would say, okay, I'll take greenbacks, I'll take silver certificates, I'll take coins. And the banker would say, well, now you're draining me of reserves. And the banker would say, that's your problem. And the country banks would be drained of reserves. They would pull some of their reserves out of the city banks. And now the city banks had a problem. And now New York had a problem. So that's the picture in all these panics. Canada, meanwhile, had nationwide branch banking. So the head office could just allocate more reserves to the countryside if there's more demand for banknotes in the countryside. And there was no limit on the amount of switching they could do between checking balances and banknotes in circulation. So there wasn't any problem. There was just a change in the mix of bank liabilities, no spike in interest rates. Whereas in the US, the scramble for reserves created a spike in interest rates and in the worst case panics. So to get out of this problem, it wasn't necessary to have a central bank. There was a lot of discussion of deregulatory reforms, meaning let's be more like Canada. They don't have this problem. So the American Bankers Association at its 1894 convention adopted a plan that would end the bond collateral restrictions on note issue and allow branch banking. Right, so they voted it up, and that was something people discussed for at least the next couple of decades. Well, more than a decade anyway. But the small banks weren't going to have it. The American Bankers Association was a group of big bankers. Small bankers were not going to have it because they didn't want large banks branching into their turf. So instead, we got the Federal Reserve Act. So the Federal Reserve Act was an attempt to deal with the panics without deregulating. And now you can understand the language from the preamble. To furnish an elastic currency under the national banking regime, commercial banks weren't allowed to furnish an elastic currency. So we're going to create an official institution to do it. To afford means of rediscounting commercial paper. That's a way of the Fed providing more reserves to banks in periods where there's a loss of reserves, which is something the clearinghouses got into doing during the panics. I don't have time to go into, but basically the Fed was going to do officially what the private clearinghouses were already doing, running the clearing system, enforcing membership standards. That's what's meant by a more effective supervision of banking, and issue notes elastically, provide more currency when the public wants more currency. And let me recommend George Selgin's account of the legislative history of the Federal Reserve Act, because it's a very complicated story. Different groups wanted different things out of it. And what finally resulted was kind of a compromise, but was mainly steered by the New York banks because they thought it was an institution that they would control. And that wasn't completely true. So in the 20th century, to bring the story up to date, central banks around the world went off the gold standard during the First World War, and it never really came back. They inflated so severely during the war that they couldn't get back to the original parity against gold. Some countries devalued, but the ones who didn't want to devalue, like Great Britain, couldn't get back on the gold standard until they had deflated by enough to bring the purchasing power of the pound back up to the purchasing power of the gold it was supposed to be equivalent to. So they never managed to get back on the gold standard. Well, they tried for a few years, but then quickly gave up. So the interwar period was basically monetary chaos. People who blame the Great Depression on the gold standard seem to think that what prevailed was a gold standard, but it wasn't. It was a chaotic mix of some countries on the gold standard, some on a gold exchange standard, some on fiat standards, and countries going in and out of these different statuses. So the Bretton Woods system was created after the Second World War to bring order to the system by turning the US dollar into the world reserve currency, with the dollar backed by gold. But when two men ride on a horse, one has to ride in front. So when it comes to controlling the quantity of money, it's either going to be the central banks or it's going to be the gold standard. And the Bretton Woods system allowed too much liberty, to too much discretion, I should say, to central banks, which they used in ways that were inconsistent with maintaining the gold standard. And so Bretton Woods broke down. And the US was one of the chief sinners in that regard. So we've had pure fiat money since 1971. And in the transition, closing the gold window in 1971, that's definitely a default on the US obligations to pay in gold. And so in the debate over raising the debt ceiling, you've heard people say that a default would be unprecedented. No, we've already had a pretty major default. So what are the market alternatives? I'm running out of time here. This will be my last slide. What are the market alternatives to central banking? Well, we could have a private and decentralized gold standard, as we did before central banks came on the scene. Although today it could work even better because we've got technology for transferring ownership of gold through the internet. We've got gold vaults today, in fact, putting their gold bars on a blockchain so that you can transfer ownership without having to go and take the gold physically out. The great advantage of a gold standard is the long-run stability of the purchasing power of money. And when I say long run, I mean over 10, 20, 30-year horizons. There are minor fluctuations from year to year if there are gold discoveries or if there are countries joining the gold standard that demand a lot of gold. But the purchasing power of gold is reestablished because when it's high, there's more gold mining. That'll increase the supply to meet the increased demand. And that'll bring the purchasing power of gold back to its long-run trend. The disadvantage is that historically, gold standards proved themselves to be vulnerable to governments that wanted to quash them. The gold is centralized in a vault. The government can force the vault keepers to turn over the gold. So that's a problem that we have to think about how to mitigate that problem if we want to go back to a gold standard and have it last. Now, a Bitcoin standard has the advantage of Bitcoin is less vulnerable to government confiscation. Although governments can quash the use of Bitcoin in public, they can make it illegal, and some governments have, to post prices in Bitcoin or post your willingness to be paid in Bitcoin. And then the Bitcoin has to go underground. It's hard. What's hard is for government to quash the underground use of Bitcoin. But an underground money is not as advantageous as a money that you can use openly. So that advantage is not as great as it might be. And the big drawback of a Bitcoin standard is that the purchasing power of Bitcoin is very volatile. It's up and down by a lot on a daily, weekly, monthly basis. So it's not a very attractive medium in which to hold the money that you plan to spend this week on groceries or rent. Right? The day your rent is due, your money balance may be down by 10%. And this volatility is not temporary or accidental. It's baked into the design of Bitcoin, because Bitcoin has a pre-specified number of units in circulation. It doesn't respond at all the way a gold standard does to there being extra demand and a high purchasing power. So both in the short run and the long run, the price of Bitcoin, or the purchasing power measured in goods and services, is going to keep being volatile. It's the concept has been raised that could we have something like Bitcoin, but that has a stable purchasing power? This idea has been given the name of a flat coin. And so in a sense, we'd have a CPI standard. Well, nobody's figured out how to actually do this, how to write the program to make it tamper-proof, because it would have to have feedback, and somebody has to control the feedback that the program uses to decide whether to issue more money. So that's an intriguing idea, but it's not really up and running yet. Now we could, and I think we should, eliminate all legal obstacles to people owning Bitcoin and owning gold. One of the obstacles are capital gains taxes. I think we should treat them as monies rather than as investments or commodities. But even apart from that, the incumbent fiat monies have a big advantage of being incumbent. People want to be paid, as Menger showed us, in something they can turn around and spend as widely as possible. The more widely, the better. So it's hard to get a new standard off the ground because it's hard to attract a critical mass. But it is possible. We see spontaneous dollarizations in countries with really bad money. Hopefully, we won't wait until we have really bad money in the US to switch to a better alternative. But we need to have a more open, a more popular debate then on whether gold or Bitcoin would be a better monetary standard. So let me end there and invite questions.
Yes. Yeah, thanks for that terrific presentation, Larry. We do have a bunch of questions that have come in. We have several that have come in from Andrew Chalk. Andrew, thanks for your interest. He's had a number of questions here, so as well as some others. So let's see, one question here. What about competing fiat currencies as a system, i.e. different national currencies? Well, that's the floating exchange rate system.
Right. But the competition can be more or less free. So back in the 70s, when inflation was in over 20% in Great Britain, the economist F.A. Hayek wrote a pamphlet called Denationalization of Money, in which he said, first, governments shouldn't stop their citizens from using a more stable fiat money if they want to. That would provide some discipline on central banks. So I think that's a strong argument. And it might be, this has been argued, that the reason inflation came down is that people were starting to exercise that freedom, and technology was making it easier to invest in Swiss francs, even while you're living in the US. So I'm all in favor of competition among fiat currencies. It's just limited in how strong a constraint it puts on a national government. It's difficult. People are not going to substitute into the Swiss franc just because it has a slightly lower inflation rate. And it's not going to stop the dollar from having 5% or 10% inflation. So it's better. It's good to have free competition among fiat currencies. I don't think it accomplishes quite as much as also having competition from gold and competition from cryptocurrencies.
Okay, another question here. As a proponent of private money, how do you assess the capital risk of, I guess, cryptocurrencies? Like,
I'm not sure what's meant by the capital risk. Um, when we talk about banks facing capital risk, it's either that they face loss of capital from bad loans, or they face loss of capital from an interest rate spike, and they're borrowing short and lending long means that they've lost present value of their assets when interest rates go up, and lost more than they've gained from the present value of their liabilities going down. But cryptocurrencies don't have that problem because they don't really have debt liabilities. And if you drew up a balance sheet for Bitcoin, although there isn't any institution that's issuing it, so it's not clear whose balance sheet it would be, the Bitcoin in circulation is all net wealth. There's no liability that goes with it. So its value goes up and down. It's a risky asset to hold, but it's not going to go bankrupt. That wouldn't make any sense. Now, if we talk about other crypto assets like so-called stable coins, Tether, USDC, which are pegged to the US dollar, those do have an insolvency risk.
Okay, yeah, there was a question about stable coins. Another question here,
so I see that. How do you assess the capital risk of Tether? Tether has a very thin capital margin. However, Tether has restrictions on the redeemability of Tether for dollars. Like there's a minimum of $100,000, and they have the option to delay redemption. I would feel safer if they had bigger capital because they've got like a fraction of 1%. But people who use Tether often don't hold it for very long, so it's kind of a hot potato. It's used to make people acquire it, make a payment, and get rid of it that way. But the people who end up holding it at the end of the day have to worry about the the insolvency risk. Tether being unable to keep the peg. They've been able to keep the peg so far.
Okay, have another question here from Wayne Abernathy. Larry, I'm not sure if you know Wayne. Wayne is a former Assistant Secretary of the Treasury for financial institutions. Wayne's question is, the Fed talks about its dual mandate of promoting labor and stable prices. What of its third statutory mandate, namely moderate long-term interest rates? How can the Fed legally push interest rates down near 0% for years?
Okay, so it's true that there is this actually triple mandate, but the Fed collapses it to a dual mandate by saying the way we keep moderate long-term interest rates is by keeping stable prices. Right? So the fluctuation in long-term interest rates is due to fluctuation in inflation expectations, mostly. Over the last 30 years, though, we've seen real interest rates, inflation-adjusted interest rates, fall around the world. So that's not due to falling inflation, that's due to demographic shifts that have increased the supply of savings and a discouraging environment for investment that's reduced the demand to invest those savings. So how can the Fed push interest rates down near 0% for years? I don't think it's the Fed that's pushed it down near zero for years. I think that's been the demographic shifts. Now the Fed, in the run-up to the global financial crisis, I would say did push market rates below equilibrium, and that helped fuel the housing bubble. But I don't see it. Well, I guess we need to look around at asset prices to ask whether there's now a bubble. And if there's a bubble, that's evidence that interest rates, policy rates are below market rates. And I do have a bit of concern about the height of the stock market, the high price earnings ratios,
Yep.
and the prices of some other commodities. Typically, when the stock market has a high price earnings ratio, it's the price earnings ratio, it's the price that comes back down rather than the earnings that go up. Now, at low interest rates, you expect a higher ratio. But I think rates are unusually low right now, and they will come up due to market forces as the economy recovers.
Okay. Boy, we've got a lot of questions here. I'll try to pick and choose here. Here's a good question from Ann Broom. Ann asks, thoughts about Federal Reserve consideration of a Federal Reserve operated digital currency, or CD, central bank, CBCD, central bank.
Central bank digital currency, that's right. I had just one allusion to that concept in my talk, which is that people who are proposing a central bank digital currency want you to think that it's the most natural thing, since government issues Federal Reserve notes, that it should also issue what they're calling a digital currency. But there are a couple of sleights of hand here. One, it's not natural for government to issue paper currency. In a fiat money system, yes, somebody has to control the quantity of paper currency, but you can allow commercial banks to issue paper currency that's redeemable for basic money, the central bank liabilities. So it isn't necessary for the Federal Reserve to issue paper currency. And when it comes to digital currency, there's a second conceptual switcheroo, which is it's not really currency. What people are talking about is everybody can have an account on the books of the Federal Reserve System. It's better called a Fed account than a Fed coin. Well, the Fed has no expertise, no experience at providing a retail payment system, which is what a checking account is. To do that and provide the service to customers that banks provide, the Fed would have to hire all the tellers and account managers who would have to be fired by the commercial banks if all the checking accounts move from commercial banks to the Fed. And the Fed there are literally hundreds of thousands of tellers in the US. I looked the number up, it was like 400,000. You can't imagine 400,000 people working for the Fed and that being efficient. They have no expertise at providing retail services. So that's one concern. I think it would be wasteful. The Fed is not the place to provide retail payment services. And secondly, if all the accounts move to the Fed, so do all the assets that the account balances are financing. If commercial banks lose their depositors, then they can no longer make loans, at least loans financed by checking accounts. They could still finance some loans with savings accounts. But the Fed is not the right party to be deciding who to make loans to either. And not just in theory are they bad at doing retail lending, they've shown it in practice. Last year, when Congress created a facility for the so-called Main Street lending program for the Fed to make loans to ordinary companies, factories, producers of various goods and services. They hardly made any loans at all because they're not really good at it. It's not their expertise. They didn't do it in a user-friendly way, which that's okay, because I don't think they should have been doing it in the first place, but they've shown that they're not good at providing customer service, but more importantly, you don't want the government deciding who deserves a loan and who doesn't. Right? The government should not be picking winners and losers in that way.
Yeah, well, we're almost out of time, but if you don't mind, Larry, if you could stick around for another 5 minutes.
Sure, I went long on my lecture, so I'm obliged.
So Robert Gay is another one of our regular attendees. He asked a question about central bank digital currencies. I think you covered that pretty well. I guess just to expand on Robert's question, he's asking about China's rollout of a central bank digital currency.
Well, there's another concern about central bank digital currency that I didn't even mention, besides it being wasteful and leading to the politicization of the allocation of credit. And that is, it's a very worrying source of surveillance of customers. If your bank account is with the Fed, then the federal government basically can monitor it in real time. And you might say, well, the Fed's independent. They wouldn't agree to that. No, the Fed is not independent in that sense. If the Treasury tells them we want to look at what's happening in these accounts, the Fed's not going to refuse. And the Chinese system is entirely designed to provide greater surveillance of the Chinese populace. China has very effective private digital currencies issued by WePay and Alipay. They're very consumer friendly, but the Chinese government wants everybody to shift over to its system. And they're harassing Alipay and WePay. Sorry, WeChat Pay. So that's my main concern with that. That's certainly not something the US should want to emulate.
Okay, let's I'll try to pick maybe just 2 more questions here. Let's see, this is from Theodore Gebhardt. In a global economy, can a country unilaterally go on or be on the gold standard?
Well, it's a very good question. If it were a small country, I would not advise them today to go on the gold standard, because gold is somewhat volatile against other currencies. So if you're a small trade dependent economy and gold was your standard, you'd have much higher fluctuations in your exchange rate than you need to have. And that would be bad for your trade. So if you're the Bahamas fixes it has a local currency, the Bahamian dollar, but it's fixed to the US dollar 1-for-1. And that makes a lot of sense in attracting US tourists. So a country could go on a gold standard, but if they're small, it would be probably not advisable. If it's a large economy, if it's the United States, well, the United States would bring a lot of countries with it. It is advantageous to have an international gold standard because you want the advantage of having a common currency area where you don't worry about exchange rate fluctuations between countries. And if 2 countries are both on the gold standard, they're in a common currency area, just like the countries in the Eurozone no longer have to worry about fluctuating exchange rates between France and Germany, Italy and Spain. They're all on the same monetary standard. So an international gold standard is advantageous. And so it's either going to have to be some large country goes first, or something like the Bretton Woods system, but which produces a gold standard in which each country holds its own gold reserves rather than the US being in a specially privileged position, because that didn't work.
Yeah, I think there has to be multiple countries on a gold standard in order to have international trade.
Well, to facilitate international trade, you can have international trade with floating exchange rates. It's just more difficult.
Yeah, well, yeah, what I meant was if just one country did a gold standard, it would be difficult for them to do international trade if they're just wanting to trade in gold or use gold.
Yeah. And so under the international gold standard, there weren't ships full of gold continually crossing the ocean. Most of the settlement is between financial capitals by wiring claims back and forth. And only rarely does physical gold need to be shipped.
Right. Okay, another question here from Craig Duddy. His question is, would the system found in Milton Friedman's proposal of automatic growth in the money supply to manage the Fed be preferable to the current system of inflation targets? So
Yeah, that's a good question. I didn't really talk about intermediate reforms between the status quo and switching to a new monetary standard, but of course there are ways to try to get better performance from the Federal Reserve without changing the fiat nature of the US dollar. And Friedman, of course, proposed early in his career that there should be a fixed rate of growth of the stock of dollars measured by M2. And that would be better than, so the Fed is given this charge, make M2 grow at 4% a year, let's say, rather than being allowed to vary the growth rate of monetary aggregates as it thinks will help dampen business cycles. Because in practice, the Fed has not been successful in dampening business cycles. And other central banks are often worse. They've introduced more instability in the economy by varying the money supply than they have reduced instability by varying the money supply. So yeah, I think Milton Friedman's proposal would be preferable. I think there are other proposals that would be even better. And I guess my favorite among those is nominal GDP targeting, where what the Fed is given a rule to do is maintain a stable path of total spending in the economy. Right, so that's known to macroeconomists as nominal GDP, dollar value of newly produced goods and services. And the implication of that is, what makes it different from Friedman's proposal is when there's a big jump in the amount of dollars that people want to hold, as there was in the pandemic, and we're only now working out of it, it makes sense for the Fed to produce more money so that people have larger real balances without the economy having to deflate, to give them more purchasing power in their money balances. It's better to do it by varying the quantity of money, but you need a guideline, and the guideline is stabilized nominal GDP. So I think that would be preferable to inflation targeting and would be preferable to money supply targeting.
Okay, well, Larry, I think you've done a fantastic job in answering some very diverse different types of questions on monetary policy and banking. So I just want to wrap things up and thank you so much for your time and your sharing your expertise. And I guess we'll end things now. And I just want to thank everyone for attending, and everyone have a good rest of the day and a good weekend.
Thank you, my pleasure.